The Federal Reserve decided to leave their Fed funds rate unchanged at the end of their March 20th meeting, a widely expected move. In addition to their decision on interest rates, we also got an update on their projection for future rates, as well as comments by Fed Chair Powell after the meeting, which dropped some clues as to what to expect going forward. In today's video, we're going to cover all that happened and what it could mean for mortgage rates and the housing market in 2024. Let's get into it. The Fed's decision to keep rates steady was widely expected, maintaining their Fed funds rate in a range between 5% and 5.25%. So nothing new there. What was more informative was the comments by Fed Chair Powell in his press conference and the release of their economic projections. In the press conference, Powell noted that a strong labor market isn't something that would keep them from cutting rates this year. This was welcome news to financial markets, as there had been some worries that the labor market's robust performance the last few months would prevent them from cutting rates. Over the last 3 months, job creation has been over 200,000 each month, a healthy rate of employment gains for the nation. So if this keeps up, it shouldn't keep them from cutting rates. What they are really looking at is the rate of inflation and if it is heading toward their goal of 2%. And here's where we are seeing some problems and why they have not cut rates yet. The rate of inflation measured by the Consumer Price Index plummeted from a peak of 9% in June 2022 to 3% in June 2023 as a result of the Fed's aggressive rate hike campaign and reduction of their balance sheet. But since then, the rate of inflation has trended sideways for the most part, stubbornly refusing to go below 3%. What the Fed is worried about is cutting rates too soon and seeing inflation head higher again. So the rate of inflation is going to be key to assessing when the Fed will start cutting rates. But once they start cutting, how far would they go? For that, we can look at their 2024 projections they released on March 20th as well. The median projection for the Fed funds rate in 2024 was 4.6% in their latest release, meaning this was the average projection of the individual board members on where they think the Fed funds rate will end up this year. Given that we are currently in a range between 5% and 5.25%, it would take 3/4 point rate cuts to get us there. This is the same as the median projection in their December release, which implies that nothing substantive has happened since that December meeting to change their minds that rate cuts are coming this year. The next question, and the one most relevant to this video, is what will this mean for mortgage rates and the housing market? Let's deal with mortgage rates first. If we want to know what could happen to mortgage rates, we need to take the 10-year Treasury yield into account. When it was clear the Fed was done hiking interest rates last October, the bond market sent the 10-year Treasury yield from a peak of 5% on October 19th of last year to a low of 3.8% on December 27th of last year. That's a decline of 1.2 percentage points in just over 2 months on expectations alone. If and when the Fed finally does start cutting the Fed funds rate, we could definitely see the 10-year Treasury yield head below that previous low of 3.8%. It's not out of the realm of possibility that it could go somewhere between 3% and 3.5% if the Fed funds rate reaches that median projection of 4.6% by the end of the year. You may be asking why this matters for mortgage rates. The 10-year Treasury yield has the most influence on the direction of mortgage rates. You can see from this graph here that the two move nearly in lockstep with each other. Over the last 20 years, the average 30-year fixed-rate mortgage rate has been about 1.8 percentage points higher than the 10-year Treasury yield. So if we had a 10-year yield in the 3 to 3.5% range, we could expect mortgage rates to be in the 4.8 to 5.3% range, which is notably lower than the current rate of close to 7%. If we did get there, what would it mean for the housing market? For that, it's all about affordability. Here's the average housing payment as a percent of median household income in the U.S., which came in at 42.5% in February, close to record high levels and well above the 30% level, which is where a household is considered cost burden. This record level of unaffordability is the reason the housing market is basically frozen right now. Average buyer is priced out of the market, as is the average homeowner, who would have to buy another house if they sold their current home. This has kept supply low and median prices that aren't moving that much. If mortgage rates came down to a range of 4.8 to 5.3%, we could see this average housing payment as a percent of income come down to 35 to 37%. Still pretty high, but should be enough to bring some buyers and sellers back into the market and get transactions moving again. Because that percent would still be well above historical levels, prices wouldn't move too much, but would likely head a bit higher as there would be a boost on the demand side from increased affordability. And that's the outlook for mortgage rates so far in 2024. The key metric to watch will be the monthly inflation reports, which will give us the biggest clue as to when the Fed will start their rate cutting. We also want to see what happens with the overall economy. Something like a collapse in the commercial real estate market or other black swan event could cause the Fed to start rate cuts sooner and cut deeper if we hit a recession. I will also be releasing video updates on the state of the commercial real estate market and economy overall, and I'll be covering everything as the new data comes out. So make sure you're subscribed to this channel. Hit that notification bell down below so you don't miss my next video when it comes out on mortgage rates or other topics. And don't forget to hit that like button on your way out to support the channel and help it grow. Thanks for stopping by. I'll see you in the next video.